Hello everyone. What if I tell you about a strategy by which we can know where the price might turn? This simple strategy is called a density bounce or a large limit order bounce. You've probably noticed that sometimes the price reverses from a zone several times, as if something is preventing the price from moving further. Time after time, the price reverses. Often, this is caused by a large limit order that's so large that the market can't overcome it. Today, I will tell you how to find such orders and how to trade these setups. But before that, let's start from the beginning. There are two types of orders in the market: market orders and limit orders. A market order lets you purchase or sell a financial asset instantly at the best price currently available. Market orders take prices from limit orders on the order book. This means you can't be 100% sure of the price you will get. Slippage can occur when you get a price different from what you expected. A limit order is an order that you place on the order book with a specific limit price. The limit price is determined by you. The trade will only be executed if the market price reaches your limit price. What does this mean? The price can't move any further until the limit order is filled. Therefore, if we see a large order in the order book, we can assume the price will rebound. That's what we're going to trade. Enter before the limit order and ride the reversal. This strategy works in any market type: stocks, futures, or cryptocurrency. In my case, it's cryptocurrency. It's one of the most volatile markets today. I'll be demonstrating this strategy specifically for this market type. Large market orders that the market cannot execute are market inefficiencies, and they are quite common in the cryptocurrency market. You can see the Bybit interface on your screen. You can see an open Bitcoin. On the left, you see a chart, and on the right, you can see the order book. In the order book, you see the price and the number of coins at that price. In the center of the order book, you can see the current price. Above the current price, you see limit sell orders. Below, you see limit buy orders. As you've probably already realized, for the price to move higher or lower, it must consume these limit orders ahead. If the price does not have enough strength, for example, the market's buyers or sellers are weak, a reversal will happen from this price. I only have Bitcoin open to show you what an order book is. Bitcoin itself is not suitable for trading using this strategy because it is too liquid, or in other words, too effective. To trade this strategy on cryptocurrency, we use altcoins, which is where very large limit orders appear that simply cannot be executed because there is not enough market liquidity on these coins. There's one important aspect to this strategy. This applies to different exchanges and trading on them using this strategy. Let's take the three largest exchanges, Binance, Bybit, and OKX, as an example. This strategy can be traded on any exchange. For example, if there's a large limit order on Binance that could stop and reverse the price, then other exchanges won't move any further, but will stop roughly where the coin with this large order stopped. This happens because of the correlator algorithms that exist on every exchange. So if you're trading, for example, on Bybit and a large order is on Binance, you can trade this situation on Bybit, but there will be some nuances and you'll need to set a stop loss with a small margin. The stop will be slightly larger than it would be on Binance. It's best to trade on Binance, of course, because that's where most of these large limit orders are. Then you won't need to set a stop loss with a small margin. A small margin is needed because, although they are correlated, there can be a slight miscorrelation. Therefore, it's most convenient to use Binance. The same applies to spot. If there's a large limit order on spot, the futures for that coin will also stop near the order because they are also interconnected. So we've discussed correlations across different exchanges and how the same coin is correlate across different exchanges. But before we move on, let's consolidate what we've learned. Now I'll show you the same coin from different exchanges and you'll see this connection for yourself. Let's take the River coin as our first example. The 15-minute time frame is currently open. Notice how similar the charts are across different exchanges. Before I move on to the next example, I'll give you a couple more seconds to look at it. Now let's look at the Tau coin chart. It may seem to you that I am showing you the same charts, but this is not the truth. These are different charts on different exchanges for the same coin. You can pause the video and try to find the differences. They are there, but barely noticeable and distinguishable. Let's look at the last example, the Rave coin. As you can see, the difference here is also subtle. This is exactly what we were talking about. Therefore, if we have a large limit order on one exchange that prevents the price from moving, then the price on another exchange won't be able to overcome that price either, due to the correlator algorithms. That's why we can trade a rebound from a large limit order on any exchange. Now it's time to learn how to find these big orders correctly. There are two ways to find large limit orders: doing it yourself, looking at each coin, or using a screener as an assistant. Using a screener is the best method because it saves a lot of time. I personally use the Dagash screener, which you can see right now. I've been using it for a long time, so I can highly recommend it. I'll use my own example to show you how I search for these large limit orders, and I'll also show you how to properly select and filter them. I'm currently in the Coins tab. There are several ways to search in this screener. The first is to go to the Screen tab. Here you'll see my workspaces, which we create ourselves. In my case, each tab is a separate exchange for searching for large limit orders. We're currently in the Binance Futures tab. It has the highest density, so it's easiest for a beginner to start here. Let's go to the settings, and you'll see the filters I've applied. If you want the same settings, you can create a new tab and follow my example. In this case, the filters are Start, enter the name, and select the exchange. In our case, it's Binance Futures. Next, go to Formation, select Coins with Densities. It's important to check the Show Only Formations box. Next, go to Settings. Enter 700,000 in the Density Volume field. Don't forget to also check Show Densities on the chart. The last section is Filters. In this window, you need to enter the coins and blacklist them. This is necessary because the rebound on these coins won't work well. Now the tab is ready. Click Save. After creating the tab, let's look at the current coins and their densities. By the way, large limit orders are called densities, so let's call them that from now on. Okay, first of all, it's important to pay attention to the coins closest to their densities. As an example, let's take this coin with hieroglyphs. Let's click on a density. When we click, we see information about that density. Here you see the price at which this density is currently located. Then we see the distance to the order from the current price. Below, we see the dollar amount for this density, and then we see the amount, but in coins. Next, we see the approximate time of corrosion of this density. Then we see how long it stands at this price. There are several important factors worth paying attention to in this table. First, where the density is located, what price it's at. If it's a round number, that's good. If the order isn't at a round number, it may not be genuine, so be careful. Next, pay attention to how long the order lasts. Ideally, at least 30 minutes, but there's no strict rule. Sometimes an order can be placed quite quickly, so this is just a guideline. Now, the most important thing in assessing density is its size. I'd like to show you a table I created that compares daily volume and order size. Here, you can see the range of traded volume I've defined for 24 hours, or daily volume, and the minimum order size that can be considered for a rebound. This is important because if a coin is very liquid, it will easily swallow up small densities. That's why, when we were setting up the tab, I set the filter to a minimum of 700,000 volume, because that's where the largest and most interesting densities are for trading. Now, let's return to our coin. How do we handle a rebound? There are two main options. The first, most obvious, is that the price approaches density, and all we need to do is place a limit order just before density. This way, as the coin approaches density, we'll enter the trade. The stop loss is placed just beyond density, literally at the next pip at the next price. The second option is more complex. When we're not entirely sure the coin's density is real, we wait for the price to hit a high and then rebound. We enter at the moment of rebound when the density holds and the price doesn't have enough strength to eat it. The stop loss here will be larger since we entered a little further than in the first case. It's placed in exactly the same way, right behind the density. Now, let's talk a little about take profit. The strategy itself is scalping, so you don't need to take advantage of big moves. We mostly take smaller ones, especially if you're a beginner. You need to learn from experience when it's okay to stay in a trade and try to take advantage. so take small moves with a short stop. Another point, if a coin bounces 2 to 3 times from density, this is a negative sign, as the chances of this density being eaten up increase. Ideally, we enter the first bounce. If the density is very high, of incredible proportions, which are rare in the market, we can consider a bounce on the second or third approach. You also need to be prepared for the fact that good trades are rare. 3 to 4 trades a day is a good result. So don't rush, wait for good trades. If there aren't any, don't trade. Trade only good situations. Don't chase quantity, chase quality. This is important in any strategy. Finally, let's look at one more way to track densities in the screener. There are 2 ways, by creating a special tab, as we did before, and this method via a special interactive map. It's accessed via the button in the top panel. Here, you can select multiple exchanges at once and monitor all market densities simultaneously. In this map, the densities closest to the center are those closest to the price. By clicking on a coin, we can open it and see its chart and density. The chart is also highly customizable, allowing you to exclude or add specific exchanges and even blacklist coins. There's a wide range of settings available, allowing for quite detailed customization. Now you know how to look for density and how to trade this strategy. Thank you for watching this video to the end. I hope you found it helpful. If you have any questions, please let me know in the comments. Bye!